Welcome to day 4 of our 30-day practical guide to building wealth through smart investing. Today, we're diving into one of the most important topics for any investor, understanding risk and reward. Let's start with a quick icebreaker. Think back. Have you ever made a financial decision that didn't go as planned? What made it risky? Would you prefer a guaranteed small gain or a chance at a bigger, riskier reward? These questions help us realize that everyone sees risk differently, shaped by our goals, experiences, and financial situations. As we move forward, keep your own perspective in mind. Let's explore how understanding risk can make you a smarter investor. Every investment, whether it's stocks, bonds, real estate, or a business, comes with some uncertainty. The outcome might not always match your expectations. That's why understanding risk is a crucial skill for investors. Instead of trying to avoid risk altogether, which is nearly impossible, successful investors focus on identifying, assessing, and managing it. This approach helps you make more informed decisions and prepares you for the ups and downs of the market. Let's unpack what investment risk really means and why it's at the heart of smart investing. So, what exactly is investment risk? In simple terms, it's the possibility that your investment might not perform as expected. This could mean lower returns, or even losing some or all of the money you put in. But remember, risk doesn't always mean loss. It just means the outcome could be different from what you anticipated. By understanding this, you can approach investing with a clear head and realistic expectations. Let's see how risk and reward are connected in the investment world. Now let's talk about reward. In investing, reward is the potential return you might earn from putting your money to work. This can come in many forms: capital appreciation, dividends, interest income, rental income, or business profits. Generally, investments that offer higher potential returns also come with greater uncertainty. It's this balance between risk and reward that shapes every investment decision. Understanding both sides helps you set realistic goals and choose investments that fit your comfort level. One of the core principles in investing is the risk-reward relationship. Simply put, higher potential returns usually come with higher levels of risk. For example, a savings account is very safe but offers low returns, while investing in a startup business is much riskier but could bring high rewards. However, there are no guarantees. Sometimes, even low-risk investments can surprise you, and high-risk ones can disappoint. The key is to understand this relationship and use it to guide your investment choices. Let's look at some common investment options and how they stack up in terms of risk and reward. Savings accounts are very low risk but offer modest returns. Government bonds are also low risk, with slightly better returns. Corporate bonds carry moderate risk and reward. A diversified stock portfolio has moderate to high risk, but the potential for higher returns. Individual growth stocks and startup businesses are at the high end, both in risk and possible reward. This comparison helps you see where your comfort zone might be. Market risk is the chance that your investments lose value because of overall market conditions. This can be triggered by economic recessions, political instability, global crises, or even shifts in investor sentiment. No matter how carefully you choose your investments, market risk is always present. The best way to handle it is to stay informed and avoid making impulsive decisions based on short-term market swings. Inflation risk is the danger that rising prices will erode the purchasing power of your money over time. If your investments don't earn more than the inflation rate, you're actually losing ground. For example, if inflation is 5% and your investment returns 3%, your real wealth is shrinking. That's why it's important to consider inflation when planning your investment strategy. Interest rate risk affects investments, especially bonds. When interest rates rise, the market value of existing bonds usually falls, and borrowing costs for businesses can increase. This means that changes in interest rates can impact your returns, even if the investment itself seems stable. Understanding how interest rates move and affect different assets is key to managing this type of risk. Credit risk is the possibility that a borrower, like a company or government, won't be able to pay back interest or the principal on a loan or bond. This is especially important for bond investors. If a company defaults, you could lose part or all of your investment. That's why it's important to check the creditworthiness of any entity you lend money to through bonds or similar investments. Liquidity risk is about how quickly you can turn an investment into cash without losing value. Shares of well-known companies are usually easy to sell, but property or certain collectibles might take much longer. If you need cash quickly, illiquid investments can be a problem. Always consider how easily you can access your money before investing. Currency risk comes into play when you invest in assets denominated in foreign currencies. Exchange rates can change, making your investment worth more or less in your home currency. For example, if you invest in US dollars but live in Kenya, Shifts in the exchange rate can impact your returns. It's important to factor in currency movements when investing internationally. Business risk is tied to the specific company you invest in. Factors like poor management, increased competition, falling sales, or legal troubles can all hurt a company's profitability and share price. Even if the overall market is doing well, a single company can face challenges that affect your investment. That's why it's important to research companies before investing. Risk tolerance is your ability and willingness to handle ups and downs in your investments. It's influenced by factors like your age, income, financial responsibilities, investment goals, time horizon, and how comfortable you are with uncertainty. Knowing your risk tolerance helps you choose investments that fit your personality and situation, making it easier to stick to your plan even when markets get rocky. Conservative investor prefers stability and is willing to accept lower potential returns in exchange for lower risk. Their main focus is on preserving capital, which means keeping their original investment safe. They often choose investments like savings accounts, government bonds, or other low-risk options. If you value peace of mind over high returns, you might be a conservative investor. A moderate investor looks for a balance between growth and stability. They're comfortable with some market ups and downs, and usually diversify their investments across different asset classes. This approach helps them capture growth opportunities while managing risk. If you're willing to accept some risk for the chance of better returns, you might fit this profile. Aggressive investors focus on long-term growth and are comfortable with greater volatility. They understand that higher returns are not guaranteed and are prepared for bigger swings in their portfolio's value. This type of investor often invests heavily in stocks or startups, aiming for significant growth over time. If you're willing to take on more risk for the possibility of higher rewards, you might be an aggressive investor. Diversification is one of the most effective ways to manage investment risk. By spreading your money across different asset classes, industries, and regions, you reduce the impact of any single investment performing poorly. Don't put all your eggs in one basket. Diversification helps smooth out the bumps and keeps your portfolio more stable over time. Before investing, always do your homework. Research helps you understand how an investment generates returns, what risks are involved, whether it's regulated, and what fees you might pay. Asking the right questions can save you from unpleasant surprises and help you make smarter choices. Never invest in something you don't understand. Markets naturally rise and fall, but long-term investors are less affected by short-term price swings. By focusing on your long-term goals and staying invested, you give your money time to grow and recover from market downturns. Patience is a powerful tool in building wealth through investing. Emotions like fear and greed can lead to poor investment choices. It's easy to panic when markets drop or get overly excited during a boom. The best investors develop a plan and stick to it, reviewing it periodically instead of reacting impulsively to market news. Emotional discipline is key to long-term success. Regularly reviewing your portfolio ensures your investments still align with your goals, risk tolerance, and time horizon. As your life changes, your investment strategy might need adjustments. Set aside time to check your portfolio and make changes as needed to stay on track. Many investors fall into common traps, investing without understanding the risks, expecting guaranteed returns, chasing high returns without research, putting all their money into one investment, ignoring inflation, panic selling during downturns, or following rumors and social media trends. Being aware of these mistakes can help you avoid them and make better decisions. Let's look at a real-life example. Peter invested all his money in one company's shares because they'd done well recently. When the company hit trouble, his portfolio dropped sharply. Grace, on the other hand, spread her investments across different assets. Some of her investments lost value, but others stayed steady or grew, reducing the overall impact. The lesson: diversification helps manage risk by not relying on a single investment. Now let's put your knowledge to the test. List 5 types of investment risks. For each, explain how it could affect an investor and suggest one strategy for managing it. Finally, think about your own style. Are you a conservative, moderate, or aggressive investor? Understanding these elements helps you build a strategy that fits your needs. In groups, discuss why higher potential returns usually involve greater risk. Which investment risks concern you the most? Why do emotions influence investment decisions? How does diversification improve a portfolio? And how might your risk tolerance change as you move through different stages of life? These conversations deepen your understanding and help you learn from others' perspectives. Let's recap the key points from today's lesson. Every investment carries some level of risk. Higher potential returns usually mean higher risk. Diversification helps manage, but doesn't eliminate risk. Understanding your own risk tolerance is essential. Research and long-term planning support better investment decisions. And finally, emotional discipline is a hallmark of successful investors. Ready for a quick knowledge check? What is investment risk? What is meant by investment reward? Why do higher potential returns generally involve greater risk? Can you name 5 types of investment risk? What is diversification? What is liquidity risk? What factors influence risk tolerance? Why avoid emotional decisions? Can diversification eliminate all risk? And what's one practical step you can take to manage risk? Testing yourself helps reinforce what you've learned. Before our next session, take some time to assess your personal risk tolerance and explain your reasoning. Research 2 different investment products and compare their potential returns, key risks, liquidity, and typical investment horizon. Finally, write a short reflection on how you would build a diversified portfolio that matches your financial goals. Applying what you've learned helps turn knowledge into action. Understanding risk is a cornerstone of successful investing. Risk isn't something to fear, it's something to understand and manage thoughtfully. By learning how different risks affect your investments and developing a disciplined approach, you'll be better prepared to make informed decisions throughout your investment journey. Keep building your knowledge and confidence as an investor. In our next lesson, we'll explore the major types of investments in greater depth. We'll look at stocks, bonds, mutual funds, ETFs, real estate, commodities, and alternative investments. You'll learn how each asset class works, its potential benefits, and the risks you need to watch out for. Stay tuned for a deeper dive into building your investment toolkit. Let's quickly recap what investment risk means. It's the chance that your investment won't perform as you expected, which could mean lower returns or even losses. But risk is part of the investing process, and learning to manage it is what sets successful investors apart. Keep this in mind as you evaluate new opportunities. Returns are the rewards for taking on investment risk. They can come from different sources, like capital appreciation, dividends, interest, or rental income. The type of return you seek should match your goals and risk tolerance. Always weigh the potential reward against the risks involved. The risk-reward trade-off is a balancing act. If you want higher returns, you must be willing to accept more risk. If you prefer safety, you'll likely settle for lower returns. There's no one-size-fits-all answer, so understanding your own preferences is key to building a portfolio you're comfortable with. Market risk can show up in many ways. Economic downturns, political events, or global crises can all cause investments to lose value. Even the best researched investments aren't immune. That's why it's important to stay diversified and not panic during market swings. Over time, markets tend to recover. Inflation quietly eats away at your purchasing power. Even if your investments are growing, if they're not outpacing inflation, you're losing value in real terms. That's why it's important to include assets in your portfolio that have the potential to beat inflation over time. Interest rates don't just affect loans, they also impact investments. When rates rise, bond prices usually fall and borrowing becomes more expensive for companies. If you're invested in bonds, keep an eye on interest rate trends and consider how they might affect your returns. When you buy a bond, you're lending money to a company or government. If they can't pay you back, that's credit risk. Always check the credit rating of bond issuers and diversify your bond holdings to reduce the risk of losing money if one borrower defaults. Imagine needing cash quickly. Can you sell your investments without losing value? That's liquidity in action. Stocks are usually easy to sell, but real estate or collectibles might take months. Always match your investments to your cash needs so you're not caught off guard. Suppose you invest in US dollars, but your expenses are in Kenyan shillings. If the exchange rate moves against you, your investment could lose value even if it performs well in dollars. That's why it's important to understand currency risk when investing internationally. A company's success depends on many factors: management, competition, sales, and legal issues. If any of these go wrong, your investment could suffer. That's why it's important to research companies thoroughly and avoid putting all your money into one business. Your risk tolerance isn't fixed, it can change over time. Age, income, family responsibilities, goals, and comfort with uncertainty all play a role. As your life changes, so might your willingness to take risks. Regularly reassess your risk tolerance to keep your investment strategy on track. Staying disciplined in the face of market ups and downs is what separates successful investors from the rest. Don't let fear or excitement drive your decisions. Stick to your plan, review it regularly, and trust the process. Over time, discipline pays off. A diversified portfolio spreads your investments across different assets, industries, and regions. This reduces the impact of any one investment performing poorly. Think of it as building a safety net for your wealth. Review your portfolio regularly to ensure it stays balanced and aligned with your goals. Remember, risk is an unavoidable part of investing, but it doesn't have to be scary. By understanding the different types of risk, knowing your own tolerance, and using strategies like diversification and research, you can make smarter, more confident investment decisions. Keep learning, stay disciplined, and you'll be well on your way to building lasting wealth.